Hi, everyone. I hope you're having a fantastic week. So, last week, spent some time thinking about okay, what are the big mega trends in tech in the next 5 years that are investable, that makes sense? And the core thesis then was what are ideas that are currently fringe that will become common? And for me, the conclusion is in the next 5 years, the big four themes are psychedelics, the no code revolution in general, climate change tech, and blockchain. So this week, I wanted to talk about crypto, blockchain, what it is, how it works, maybe explain misconceptions that people may have, and go A, reasonably high level and definitional, and B, in depth in terms of what actually is going on in the space. So without any further ado, let's get going. Welcome to episode 28, What's Up with Crypto. So basically, before start going, there's a lot of misunderstandings or misconceptions. I think because there's been nothing for people to spend money on in the last year, as the stimulus checks came in, the savings rate in the U.S. went from 7%, which is the historical average for the last 20 years, to like 13%. There is not too much for people to do with that saving, and a lot of that saving ended up going either in public equities on the Robin Hoods of the world and leading like meme stock events, or in crypto. But I think many of the investors in crypto are more speculators. There's like, oh, these things, they're coins, let's buy them. They go up and to the right all the time. They don't necessarily understand what it is, what they're for, how they work, what are the use or usages of them. And so I wanted to basically clarify that and talk about like the state of crypto in 2021, where we're going from next, and what it also means for FJ Labs as a venture fund and our thesis and philosophy. So get going on that. So basically, before I get going, I want to talk about like basic definition. And what's probably worth understanding is what is crypto. So cryptography, the actual definition is it's just a hidden meaning. It's making things hard to guess. Now, what a blockchain is really just a decentralized database or a decentralized computer. The block is the information, and the chain is how it is tied up. Now, in this world, things are decentralized. Which means instead of having everything on one central database, it's stored across many different computers. Now, there's some use cases for that. Not everything will move to decentralized because, of course, it's slow, it's expensive. But if you want things that are completely trustworthy and cannot be altered, having a decentralized database with a consensus system for guaranteeing that the truth is the truth is actually helpful. So you can imagine that maybe for voting records or some financial transactions, having a decentralized system is helpful. But if you want something to be super responsive and inexpensive, actually centralized systems will be here to stay for the long run. This is just a new competing platform or a new platform that's emerging, and applications are emerging on top. So continuing on definitions before I talk about like use cases, etc. Once you have these decentralized computers, they need to agree on what the truth is. And the way Bitcoin does it is something called proof of work, which means every 10 seconds, we recalculate more or less the chain to make sure that we all agree on what the data is. So hackers can't really change it because they need to hack essentially 51% of the computers that are mining in order to change the truth. Now, the issue with that is it's reasonably power intensive and or energy consuming. So many of the new coins or chains or applications are moving something called proof of stake, where you're just becoming a validator, being paid for doing that, and you're just staking the amount or some amount of that cryptocurrency. It's 99.5% more efficient. Ethereum specifically is actually moving from proof of work to proof of stake, with one big release happening today on the path for doing that. But other chains like Solana, which are really decentralized computers, which can build applications on top, or doing that, or have done that already, or Polkadot, who are built that way. I will, Mariano, I will post the presentation on my blog once I put the summary and transfer this. So Bitcoin was the first use case of the blockchain, of these decentralized database or computer. And the idea that Satoshi Nakamoto initiated originally was really a peer-to-peer electronic cash that was by design deflationary. I think the original vision really wasn't fulfilled because it was meant to be a peer-to-peer cash payment system, whereas it's really transformed into a form of digital gold. Now, Bitcoin doesn't really have a very sophisticated programming language. It's really, and as a result, while there were in the early days like debates in the community as to what it could become, essentially people have kept it simple as a means of being an alternative to gold. Now, many people were like, "Wait a minute, why is this valuable? Why is this interesting?" Now, most assets in the world, their value stems from their utility, and their utility can be measured by the cash flows that they generate. So if you buy a bond or if you buy stocks, you get a part of the profits or part of the dividends, or the value accrues in the stock price itself. And so for most assets, if you have real estate, you could rent it out. Their value is the net present value of the discounted future cash flow. By the way, that's why when interest rates go down, the value of the assets have a tendency to go up. Now, there's a set of assets in the world where the intrinsic value actually, which don't have intrinsic value, that the value comes from other people believing they have value. That's true of art. That's true of maybe collectible cars. That's true of trading cards, by the way. That's true of gold for the large part. Now, gold has a little bit of utility value. You can use it in certain applications, but most of the value of gold derives because people believe it has value. Well, this is true of Bitcoin as well. So it's one of those assets that maybe is a store of value. It's a form of digital gold. Now, why would you use Bitcoin instead of gold if you need a store of value? The use case I like to think of is, imagine you don't live inside of the US or Europe, and instead, can't see the presentation. Make it full screen. Maybe this will help. I'll make it bigger. So imagine that you live in Argentina over the last 25 years. And over that time period, you've seen arbitrary confiscation of some of your assets. You've been conversion of your dollars into pesos. And so you don't trust the banks. You don't trust the central government. So what can you do as an alternative means of saving? Well, you could buy gold, but physical gold, it's heavy. It's not that convenient to trade in or transact in, or you're going to bury it in your garden. And if things, the shit hits the fan, you can unbury it and travel with it. Diamonds maybe are a little bit more portable, but these things are actually rather inconvenient. It's actually not a coincidence that many of the early crypto entrepreneurs were actually Argentine, were coming from countries where rule of law or where the exchange rate systems were not very flexible. And so an alternative that's in a way more convenient and very secure, where you can transact, actually makes sense. So Bitcoin, again, doesn't have intrinsic value. The value comes from the fact that people believe it has value. Now, people keep asking me, is it going up? Is it going down? Well, it's hard to tell, right? Like as a percentage of the wealth in the world that's allocated to store value, it's very low. It's underrepresented. You can think, in the future, banks, maybe even central banks, wealth managers are going to allocate more of their savings to it, and it'll make it go up. Now, in the short run, though, perhaps the flow of speculative money that came in with a high savings rate, the stimulus money, maybe that goes away, and maybe the price goes down. So I don't actually speculate on the price of Bitcoin. I hold some Bitcoin. I'm not adding to the position of the current prices, and I'm a happy long-term holder. But it's a tiny percentage of what I hold because it doesn't have, again, intrinsic value. I prefer things that actually have intrinsic value. Now, a few things to think about in terms of Bitcoin. It's not a currency. If you think of what the definition of a currency is, it's a medium exchange. You can give it to someone else to get some goods. It's a unit of account. It has to be generally accepted, and it has to be inexpensive to transact with. This is not true of Bitcoin. The prices are in dollars. Bitcoin is not generally accepted. But it is a store of value. Now, is it a security? Now, the SEC recently said that Ether and BTC are actually commodities for tax purposes, but the reality is on the Howey test, it actually is not quite clear, right? Because it is investment money, there is expectation of profit, and to some extent, it may be derived from the efforts of others. That said, most crypto actually are securities, and we can talk about what that means a little bit later. Now, maybe perhaps more interesting is what's been built since then. So Vitalik built Ethereum, and Ethereum basically allows or has these smart contracts that people can enter in. What's great with the smart contract is the software essentially executes the contract. It used to be you wanted contracts to execute, you need a third party, you need a court of law, you need in a way a judicial system to educate contracts. Here, it's automated, and so the amount of things you can build on top of that is pretty extraordinary. Now, the way I think about like Ethereum is really is a decentralized computer, and you're building applications on top of that computer. So the applications you're building on top of things like Ethereum, but one example amongst others, are dApps. They're decentralized applications, and they're built. Obviously, you're not putting in all the computers. You're building it on a virtual machine, basically, that runs on top of that. So what's really exciting or interesting here is think of things like Ethereum as a global distributed computer. You can buy computing power on it, and you're building these applications that can do a lot of different things. And I'll give you a lot of examples of what's built. Another really exciting thing that's coming out of this is you're seeing DAOs, which are decentralized autonomous organizations, which basically are a group of people getting together to do something. It's kind of a replacement for LLC in a way. And I'll give a few really cool examples of DAOs later, which have become essentially investing organizations investing in crypto. So Ethereum, as I mentioned earlier, is essentially a global decentralized computer. Now, today it's on a proof of work system, but basically the way it works is you build applications on top of, you can build applications on top of Ethereum, and in order to make the system run, you basically pay what's called gas fees. Now, the issue is today is rather expensive, it's rather slow, and that's why a number of competitors like Polkadot or Solana have emerged. That said, to address that fact, it's not that scalable or and that is rather expensive, they're moving to a proof of stake basis at some point in 2020. And actually, they're probably worth mentioning, there's a conversation going on of will it remain the primary decentralized computer people building on top of? And it's not 99.1, right? Like today, it has a critical mass of developers. Most of the developers are building on top of Ethereum. But there are a number of like counter arguments or parties saying, oh, it's actually really hard to be, forking it and changing the way it is. Maybe the miners are revolted. So it's maybe 80-20 rather than 99. Also, I don't think this is winner take all. There will be multiple players that will use different nuances, but depending on the types of applications you want to build, you might be better off on Ethereum or something else. That said, to date, most of the most successful applications built, like Uniswap, are built on top of Ethereum. I'll talk about them in a little bit later. A few more definitions, and then I'm going to get into like where we are, what are the examples, what are the companies, and what I invested in, what isn't. So the tokens are really the digital assets that live on the blockchain, and they can be useful for something. They could represent something. NFTs. Now, NFTs have been a craze this year. They mean non-fungible token. They represent an individual asset. So if you own an NFT, it's a unique representation of something that you own. The issue, or people have a hard time wrapping their minds around, is like, why are these things worth anything? Well, why are your collectible cards worth anything, right? Like, why is your Birkin Hermes handbag worth as much as the market says it is? It's because we attribute value to it. The same reason art is worth what it is. And in this case, you're like, wait a minute, it could be replicable, but perhaps the original print of a 100 print collection also has a level of value. So they represent unique items that have varying value. Another way to think about it is imagine you're in a game. If you're playing World of Warcraft and you buy a digital good, or in your Fortnite, those goods belong. I mean, you have the right to use them. They technically belong in the case of World of Warcraft to Blizzard. In the case of Fortnite to Epic. Here, perhaps you play games where when you buy digital goods, you actually own them, and you can then trade them on the platforms like OpenSea or Rarible, and we'll talk about that a little bit later. The last thing to think about that are relevant is what are governance tokens. So basically represent the voting power in the blockchain. And because you could vote yourself percentage of the profits, I think of governance tokens as the equivalent of equity in a project. And in fact, often we invest in the tokens rather than investing in the equity of companies, and I'll talk about why a little bit later. Okay, let me check the questions. Are NFTs considered a crypto or application or something else? The NFTs or the token, the application, they wouldn't be the application itself. The application itself would be a game like Top Shots, or would be something else. Okay. Now, many of the transactions that are happening you need to buy them. And it's actually, most places, especially decentralized ones, don't take fiat currency. They can't send dollar in. And so you need to buy them. With stablecoins, which represent, if you have $1, which has, let's say, it's backed or it's linked to another asset, usually the US dollar. Now, there are multiple ways stablecoins have been built. The fiat based, like Tether or USDC, where in theory, for every single dollar that is put in, there's a dollar counterparty, and therefore it should always be worth 1 to 1. Now, there's some drama around this because perhaps there's been a bunch of lawsuits. People are alleging that Tether actually created money with actually the fiat, having the fiat current backup, and even USDC, because it's a centralized exchange. You may want, there's always the lag between the volume available and the actually transactional record of how much fiat they have to back it up. That today USDC looks like it's going to be the way. There's a bunch of other ways to build stable coins. So far, all the other ones have ultimately kind of collapsed at some point or other. If they haven't been fully backed. So TBD. My current bet in the centralized one is USDC, but there's a decentralized one that's emerging that's really, really cool. That's Terra. Now, when you look at whether or not these applications are working, you can see all the value that's locked in them. That's the total value locked. And then you have these exchanges. It's not because they're on decentralized computers that the exchanges have to be centralized. Many of them were actually centralized. So crypto finance space, you have two types of places where you trade. You have the CEXs, or the centralized exchanges, or the DEXs, which are the decentralized exchanges. So centralized exchanges, there's basically a company operating. They're often regulated, and they're doing the matching. In the decentralized ones, the counterparty is not the exchange. It's just other people creating the market. And I'll talk a bit more about how that works and why it's exciting and where the world is headed. Now, of course, in 2021, we saw a huge explosion in crypto. The value exploded until March, April, where they kind of had this mini bubble bursting, where the value half since then. But regardless, last year, starting last summer, is considered the summer of DeFi. We've seen things like Uniswap go from nothing to $1 billion a day trading volume. So definitely there's a there. Something's happening. Major institutions are putting more money into it. There are massive venture funds that are allocating capital to it. So something's happening, and it's really interesting because it's basically the genesis of a new computing platform. New applications that we can't necessarily think of are going to emerge using the benefits of decentralized computers. And we will see what that is. I think we're still day one, but clearly finance, especially, is being reinvented in a decentralized way without the need for banks. Now, will this all come crashing down to an end? Now, it was a little bit of the wild, wild west, and you had a lot of the central exchanges that didn't want to that pretended, like Binance, that they weren't located anywhere, they didn't buy any regulation. So, as I think through the future, will regulation impact the space? Absolutely. Is there going to be regulation? Absolutely. Will it kill the space? No. And in fact, the centralized exchanges are begging to be regulated, at least some of them, like Gemini, Kraken, or Coinbase, because they want to be the on-ramp. They want to be the place where you take your traditional finance, your dollars, and you put it into the system. So I suspect there'll be a schism where you're going to have the centralized exchanges that are agree to play ball. They'll be regulated. They'll be reporting to tax authorities. They'll do KYC, etc. And then you'll have the decentralized exchanges probably will remain largely unregulated because they're frankly not really stoppable. But they'll be used by pro users and a subset of the users because they're actually really hard to use. And they're really hard to use by design you could never really have a Uniswap that has the ease of use of a Coinbase, because otherwise there'd be a point where the regulators can interact with that. Now, so all that to say, I'm bullish on the space. Where in the early days, there's a lot of applications that are going to be built. There will be regulation. It probably will impact the prices, and there'll be crackdowns in countries that probably don't want other crypto to exist because they wanted to control the currency. So, like China is really doing a crackdown, I suspect, to push the digital yuan. But in the long run, I suspect there'll be a lot of extraordinary applications decentralized. Now, what's happening today from an application perspective that's exciting? Now, the most exciting thing is probably in finance. So historically, you would have markets, like the NYSE, the Euronext, the Nasdaq, where you would trade stocks, bonds, foreign exchange. Now, we've seen the creation, the equivalent of that, to trade in centralized exchanges, first in the Krakens and Coinbases of the world, using more or less the same mechanism, which is an order book. And then we saw, it took a while, decentralized exchanges built on top mostly of Ethereum. And now what's interesting here is, Uniswap was launched in, like less than a year ago. They're doing $1 billion a day in trading volume, and they've removed all the intermediaries. So the amount of work or the amount of fees that they charge is de minimis. Where the Coinbase of the world can do like 3%, sometimes more, they'll take 30 basis points for a large transaction. And so liquidity has a tendency to move to them. Now, because Ethereum is slow and expensive, they actually are not an order book system, especially because they need liquidity providers in the less liquid pools. So they use a new innovation called an automated market maker. And I'll talk a little bit about that later. But in the long run, I suspect that there will be decentralized changes on an order book system for the liquid pairs, because the underlying chains are going to be a lot more scalable and a lot faster. The Uniswap is really exciting. It actually came out of the idea of one of the Ethereum co-founders that you should do automated market making, and they take 0.3% of every trade, and of that they take 0.05%. And as I said, they're at $1 billion in daily trading volume. These are their revenues, which is the largest. They were at I think they peaked like almost 400 million revenues in May. Now, what's interesting is, if you want to buy some crypto and you swap it for something else, you pay the fees. You're the one paying the 0.3%. It could be more if you do smaller transactions, 3.6% or more. And then there are people that are providing the liquidity that are receiving the fees. And it could be people that just want to accumulate fees, or people that are like splitting their assets across different platforms. And so if you think of like the trend of traditional finance going to crypto, you have centralized exchanges and decentralized exchanges, both of which are doing really, really well. But the approach is rather different, because if you think of if you look at how it works, Coinbase is like 1,300 employees. Uniswap is 30 employees, and they're doing like a third of the volume. But in order to use Uniswap, you need to be technically savvy. I mean, you need to have your own wallet and MetaMask, which is not easy. You need to connect to Uniswap. You want to deposit Ether, and then you can swap. And by the way, if you want to if you want to get your crypto into fiat, it's really, really hard outside of the centralized exchanges. At Coinbase, this Coinbase approach is because they're cheaper. They do their KYC. You can put money in through an ACH transfer, a wire transfer. I think maybe even a credit card, for much higher fees, and you can buy and sell. This is a bad UX UI, so a lot cheaper than the Coinbase main one. So you can create a Coinbase account and then just go to pro.coinbase.com. They'll bring you to that UX UI. You can transact there for cheaper than the core Coinbase. That said, you should probably use all of Coinbase for research, etc., because the UX UI is a lot better. Now, Binance was, partly still is, the largest centralized exchange, but is under regulatory threat right now, because they did a number of things which I think in the long run will happen. Like, they created the equivalent of stocks on that you could trade on Binance, and so it wasn't the stock itself; it was the representation of stocks. So you could trade the Apple stock or the Tesla stock. But that currently violates securities law, and they also refuse to do KYC and report to the tax authorities. And so there's been a massive crackdown on them. And as I said, I suspect in the long run, anyone in the centralized space who refuses to be regulated will be like killed or die. And so the people that are regulated, the Krakens, Geminis, or Coinbase of the world will do really well. And a big chunk of the space for the professional traders who don't necessarily need all of this will move to decentralized finance, and both will coexist. But it's not clear that DeFi wins all and beats centralized finance just because you need effective on ramps. And I'll talk about like some of the companies that we're investors in that are helping with that. Now, the same way that the stock exchanges, if you wanted them, traditional finance is being reinvented, we're now seeing lending and saving that's being reinvented on crypto. And it's being reinvented the same way with centralized solutions like BlockFi or decentralized solutions like Aave or Compound, where basically now, none of these people actually do real credit checking of how worthy you are. So the way it works is if I want to borrow $750, I'll put $1,000 worth or $500 depending on the exchange. I'll put $1,000 worth of Bitcoin, and in return you get $750 or $500 worth of USD, which you can do something with. And this is where I'll talk about how they work, how it works exactly, and what people are using it for. And that's why I actually don't lend. So this is an example of Aave. So Aave is one of the decentralized lending platforms. It's actually really, really cheap to originate, and it automatically finds a pool of people that are lending to you when you block or when you put your money in escrow. So these are all collateral. Sorry, in collateral. These are all collateral based systems. Now the reason I don't actually lend is you don't actually know if you're a lender who the counterparty risk is. So they what are the pools look like, and when I've looked at the behavior of people around me, it looks like they'll put 1,000 BTC, they'll get $750, then they'll buy more to PDC and they'll borrow against it, and so on and so forth. So they're highly levered. They're using this to do leverage long trades on BTC, Ethereum, or whatever. And it doesn't take a very large movement in price points to actually lead a default. And so I'm worried. I'm very worried about the likes of BlockFi versus the Aave compounds because in a way they become the counterparty. And I said I think BlockFi now has raised at like 4 or 5 billion valuation, and they're a centralized lender. But again, you don't really know what risk is being taken in there, and and the collateral may or may not be sufficient. And by the way, in the case of BlockFi, I think there are a number of institutional borrowers who don't need to post collateral or post limited collateral. So it wouldn't take a too huge a move to have the entire thing like falling down as like a house of cards. That said, if you're looking for yield, to date, it's been a one-way bet, and you've done rather well. But I prefer staking, and I'll talk about staking shortly. Just to as a side note, every major element of finance is being reinvented. So not just the exchanges, but you also have the lending, and you also have like insurance with products like Nexus Mutual. You also have derivatives. Deribit just raised at a very large, and they're a centralized derivative exchange platform. You have decentralized exchanges like Open. So basically, every component of finance is being reinvented. Now they all take fees, but much lower fees than your traditional banks, and they have much lower cost structure, especially in the DeFi world, where you basically have a company like Uniswap with 30 employees that can trade billions and billions of volume. And so we're still at the very beginning of this, and the traditional banks are going to be reinvented, where the cost structure basically being squeezed as people can start transacting in, frankly, every financial instrument possible. So this is really an extraordinarily exciting area of the category. Now you can. The part that's also interesting to many is like this is an interesting way potentially to save and to get returns, right? Like today, you put your money in your savings account, you're earning 0.01%. But in many of these, in crypto, you can do different things that lead to other yield. Now, you could get 40% in if you lend to Argentina, but I probably wouldn't recommend that because the default risk is really, really high. So there are 3 ways that people can earn here. Lending, which I covered. I'm not a huge currently fan of that just because you don't understand the counterparty risk. You don't know what the default risk is, and it's all collateral based versus credit risk modeling, and the rates are not super high. The only thing that'd be okay to lend actually is against USDC, because there, of course, it's back to Section 101. So what you could do, by the way, which actually would lead to maybe a 10% yield, is you lend you lend USDC, which currently leads to like pays you 2%, and then you lever that up and you can get like 10%. Now staking, which is proof of stake to be a validator, I think is a probably safer way to earn cash. The issue is not that easy to do, but there are two companies, especially one of which for investors in called Figment and Stake, that allow you to stake, and you get compensated for staking and being a validator in the system. But all these things come with risk. So in the case of lending, you don't know the counterparty risk. Obviously, if you're staking, maybe the coins that you're staking are going down in value. Now, the reason I actually like staking is I'm long on the coins anyway. So, and on things like Polka, I think you get paid like 20% a year or whatever being a validator. So it's totally worth doing if you're long on the coin anyway. So I stake pretty much everything, lend USDC occasionally, and lever it up. Now there is risk here. In some of the stable coins, especially the ones that are not backed by fiat, I think have the risk of collapsing. So far, none in the long run. I think none of the non-fiat backed stable coins have held up. So I probably wouldn't use any of the stable coins other than USDC today. Or the funds you invest in can be actually run by crooks, and they can take all your crypto, or you can be hacked. I was hacked pretty infamously a few years ago. I actually published an article of what happened, where I was using very basic primitive security of like two-factor authentication on my phone, and I use a normal email, and people called T-Mobile, pretended to be me, asked to have a new SIM activated, and they used that to reset my email, and then they had my email, and they had my phone, and they logged into my crypto. Now, it was like, I don't know what BTC was at that point. It was like during the last bubble in 2017, 2018, and I just sold my crypto a week ago. So it ultimately ended up sealing 0.01 BTC. But after that, I completely upgraded my security. All of you should use an email that you don't use for anything else, and you should all use a hardware key, like YubiKey, in order to trade crypto. So it looks kind of like, like this, or like this. And without the hardware key, people cannot transact. And actually, I don't mind some of the limits they put on like things like Coinbase, because you can't withdraw too much cash. The other big trend in crypto has been Web 3.0. Now, Web 3.0 has been a moniker that's been thrown around. People talk about it. I've mentioned it in many cases. What it seems to be meaning, the consensus of what Web 3.0 means today, is a web where you own your own data, and where you're moving the power to the individuals and the creators as opposed to the middlemen like Google, Facebook, or whomever. And the reason this is compelling is, there's this post from Kevin Kelly a while back that in the modern age, in the future of work, people will be able to live out of their passion as long as they have 1,000 true fans that are willing to pay them. Now, in the normal Web 2.0 world, you have the likes of frankly YouTube and Instagram or Patreon or OnlyFans or Cameo, where creators can make a living. But there is a belief that a lot of that will move on the blockchain, where creators will be able to interact with their fan bases without these intermediaries between them, and to create monetization options. And again, we're still at the very beginning of the creator economy of this future work vision. It is one of my big pieces that I'm investing in, both in the Web 2.0 world and the Web 3.0 world. Now, NFTs could be a way to do that. And I'll talk about a few companies that are doing, allowing creators to issue coins to sell for whatever. It could be to sell merchandise. It could be sell a one-on-one session with them to chat with, etc. And if you think of where we are today, despite the massive boom earlier this year, relatively traditional art market is tiny. Relatively the amount of willingness to pay for interactions between fans and creators, I think, is also tiny, which is going to be much larger than the art market itself. So a few of the NFTs that are doing best by volume: NBA Top Shot, which is these collectible cards; Axie Infinity, which is a really interesting example we'll talk about shortly. Now, Top Shot, collectible cards, they've existed before. They had value in the offline world. They'll have value in the online world. It just so happens that in this case, it was built on top of crypto. Now, what's interesting is they're not interoperable. They actually don't let you trade on OpenSea. You have to trade on Flow, but still one of the categories that's going to emerge. Maybe the most exciting new area or company that came out recently is Axie Infinity, where users basically receive their tokens as reward for being in the game's universe. So think of it as like Tamagotchis that you can buy, breed, sell, and then you have them fight. And what's interesting as a business model is you could like stake it. You could buy Axies for someone. They can earn money by fighting, staking, breeding, etc., and you can earn a collection of that. So kind of created a new modern business model for digital games, which we've never seen before. So this is extremely exciting. I think this model is going to be copied by many different types of games all around the world. But this is created now. They're at like $7.5 billion market cap. I haven't checked recently. It might even be more. But this is like a very exciting new way of gaming, and definitely I guess a portrayer of things to come in the blockchain and crypto gaming community. Now, many of the crypto then can be traded, and there's a bunch of companies like OpenSea or Rarible people can trade, and we're indirectly through Animoca investors in OpenSea. Now, really interesting things that are going to happen, like I mentioned, in the future, in that 1,000 true fans are going to be able to allow you to fund your living. The companies like Rally that are being created that allow people to create coins. So if you're, I'm making it up, but if you're like Beyonce, you have the Beyonce coin, and people could then use it to interact with her or buy stuff from her or whatever. Bitsky is a Shopify for NFTs, so it's an infrastructure provider allowing other people to basically sell, buy NFTs and connect them. Or BitClout, which is a means of rewarding people for the content that they create. So there's a lot of like innovation around creating the creator economy in the crypto world. And several of our companies use the Graph, which is kind of like Google for blockchain data. They index the protocol. Both Figment and Galleon, or Clipper, sorry, it's called the new name, use them. They're doing also rather well. So what are we doing at FJ Labs in crypto? So basically, in each of the different categories, we've basically made bets. So we're investors in a decentralized exchange, Clipper. We are investors in a wallet, Zengo, which is super easy to use. And frankly, if you're trying to get into DeFi and you need a wallet, I would go with Zengo. I think ultimately they have a much broader vision than that. They're going to be the on-ramp for, they're going to be connected to fiat. You're going to be in a position to trade or transact in the different currencies there, and it's going to be amazing. We're also investors in different funds to see what they're doing, like Libertas or Multicoin. And in the NFT space, we're investors, especially in Animoca, which is kind of a holding company. So Clipper, which one of our EIRs at FJ Labs launched like a few weeks ago, it's pretty epic. They launched a few weeks ago. They're already like at over $1 million a day in trading volume. They're in the top 10 DEXs as of today, if I know correctly. And they're going after the prosumer Uniswap users. So people that are doing 1,000, they're like $10,000 trades, where on Uniswap would be 50 bips. Here they take 30 bips, so including slippage. So it's actually cheaper and makes a lot of sense if you're like these more mini power users. Now, again, it's still not for the everyday person because you need a MetaMask and it's not easy to use. But this is a way to attack Uniswap, and I think a lot of liquidity could go here. Now, in the long run, where do the fees end up being? It's not completely clear because the liquidity just moves to the lowest cost, cheapest provider. Do they tend towards zero? And if so, how do you reconcile, having them as ongoing concerns? Figment, which we're investors in, is taking a service. I mentioned them before. I use them to stake all of my crypto. Again, not super easy to use, but the much easier than the alternatives of becoming yourself a validator. Animoca, which is a kind of both a holding company and an operating company, they just raised money at $1 billion valuation. They're investors in, they run 24 metaverses. They own 51% of the sandbox, and then they're investors in a whole bunch of things from OpenSea to Dapper Labs, or actually I'm not sure they're investors in Dapper Labs, but definitely OpenSea, Axie, and many others. And this is like all the type of stuff they've done. I mean, they're super active. So it's our main bet in the metaverse universe and the NFT universe. So what does it mean for, well, I guess for you guys and for FJ Labs, or possibly different things. For you guys, I would say the things that have utility, I find personally more compelling. And so I would look at, like, especially if you're in finance, I think it's a no-brainer to be active in the DeFi space. And whether you're staking, you're lending, or trading. And I think today, because there's not been a lot of sophisticated trading strategies, you can actually use some of the best strategies from the quant space into crypto and make a very good living. For most people, probably means if you want crypto exposure, it's probably simpler to just buy 50% Ethereum, 50% BTC, let it sleep, never look at it. Just make sure you have proper security. I'd do it just in Coinbase, use a YubiKey or a hardware key, and an email you don't typically use, and yeah, fire and forget. I'd say most people should probably have, I don't know, 2 to 5% of their assets in crypto. It's too complicated for most people to like actually know exactly what's going up. What are the ones that are like trending and moving rapidly? It's a space that's very rapidly evolving, and unless you're paying attention, it's actually really, really hard to know which coins to be an investor in, because it could be that the new release of Aave is marginally cheaper than Compound, and the liquidity moves from one to the other. And if you're not paying attention, you could lose a lot of money. So you're probably better off just owning Ethereum, assuming it's going to be the main decentralized computer, owning BTC, assume it's the future of digital gold, let it sleep, don't look at it. And by the way, I wouldn't be an active day trader in most things either. Like I look at my stock portfolio like once a year. In January, let's say January 1, decide to rebalance. You shouldn't be doing more than that. Now, what does it mean for us as a VC firm? Now, there are 4 ways that people have been investing in crypto. One is crypto dedicated funds, like DCG, which is my friend Barry Silbert's fund, that are just fully dedicated to investing in the space. 2 is you have normal funds that are creating verticals dedicated to crypto. That's what Andreessen Horowitz did with a ginormous crypto fund run by another friend of mine, Chris Dixon. Then 3, you have traditional funds that also see crypto as a core investable area, and they have a thesis. And that's where version 1 or USV are acting. This is frankly what makes the most sense for us. The other one probably worth mentioning is the DAOs that I mentioned earlier, which is a new form of like LLC replacement. People coming together to invest in projects. And so you have like Crypto Cartel or Flamingo, which are investing. And what's interesting is when they invest in a project, these are also the users of the project. They can stake it. They can be active proponents of it. And so actually it has like a built-in PR marketing. Now, when you're investing, you can invest in the equity of the company, in the early stage tokens, or the liquid tokens. Now, for people like FJ Labs, we're not, registered investment advisors. So liquid tokens wouldn't make sense. Now, us as individuals in our wealth management strategies, we can invest in liquid tokens. But for an FJ Labs type company, investing the equity or the early stage tokens makes the most sense. Now, to date, most of the value has actually come from being in the early stage tokens rather than the equity. Which doesn't necessarily completely make sense, but that's been the path. And so this is really where we play. So if you look at like what people have done, we fit more in the mold of the version 1 USV, which are traditional VCs with a crypto thesis. And so summary of trends, blockchain, which is decentralized applications computers, will becoming a traditional force in the world. It's completely reinventing finance right now. And there's a new emergence of trends in Web 3.0 with people controlling their data with and the creator economy being pushed in a major way. Now, what it means for FJ Labs is for traditional VC of the crypto thesis, we're going to continue to focus on what we've done historically, but we're adding a crypto arm. Now, the reason it makes sense, by the way, is all these things are marketplaces. What is Uniswap? It's a marketplace between a buyer a buyer of a coin and a seller of a coin, or same for Clippers, same for Aave or Compound, a borrower and a lender. So these are all marketplaces. They fall straight down in our core thesis of what we do. And so to date, we've had three core theses of verticalization of horizontals. So verticalizing the Thumbtacks and eBays and Craigslist and Uber Eats of the world. We had fake marketplaces where the marketplace picks your supplier. We had B2B marketplaces writ large, and now we're adding a new thesis in crypto marketplaces. And for that, we're recruiting a dedicated associate that's going to be going after and looking the space and keeping his fingers on the pulse of the space. We'll be not leading, as we don't usually do. We'll be writing small checks in early projects to people that we love, working with our other VC friends who work in the space, and it'll be pretty exciting. So, kind of announcing the new launch and actually also a new hire, which we haven't identified yet. So that's on the to-do list. So if you happen to be a crypto expert, fascinated by venture capital, and want to have some money to deploy in the space, should send me an email, apply, and we'll see what future exciting investments we make. We're still like day one. The amount of applications that can come from decentralized databases and computers are extraordinary. We can't even begin to fathom what they're going to be. Now, for all the people that are asking, the PowerPoint will be shared on my blog. So what I do after the live show, eventually I'll write a little summary and I'll post it on my blog, and I will include the full PowerPoint. It takes me a while to do the summary and the transcription, so it'll be a few weeks, but the full presentation will be online. Little reminder, if you want to trade, for most people, I'd say just go to Coinbase Pro. Well, create the account at Coinbase, then you log in at Coinbase Pro, and definitely use a dedicated email and a YubiKey so you don't get hacked. And with that, if there are no questions, I'll see you in a few weeks. I'll be off next week. I'm going camping in Jackson Hole, but as soon as I get back to real internet, the next episode will be on what have been the marketplace trends that I've seen in the last 12 months. Because even though, if you take a step back, there's a clear meta trends are emerging. See, Cassie, thank you for the presentation. Do you have any additional recommended resources to learn more about crypto? Yes, there are a bunch of newsletters that are worth reading, like CoinStack, etc. There's in fact, there's some of the Substacks where there's like so much like basic intro information. Like there's one on Substack. Google it, and it says like crypto. Explain it to me like I'm 5 or something like that. It's recent, so if you Google that, you'll find a lot of older posts. But if you find the recent one on Substack, that's the one, and they have a whole bunch of like other basic information. But frankly, one of the easiest things to do, well, I mean, the thing is, what I don't love is that most people just go to Coinbase, put money on, buy stuff, and they have no idea what they're buying, what intrinsic value these things have, which is, I guess, okay, but it's pure speculation. But not a bad idea to at least understand a little bit of what it works. Of a good way for the average person to earn their first crypto via credit for doing social good that can be validated in the blockchain and redeemed for crypto. Not that rings a bell from that approach. For the average person, right? Like, so most people would be the creators that are getting compensated in crypto for what they do, or you have the miners, or you have the stakers. For the average person, frankly, just buy some crypto, hold it. I think it's frankly by far the easiest way to interact with the space. Okay, so I think that's it for this week. Thank you all for joining. This was super fun. It was actually a lot of fun to put all this together for you guys to research and to think through the new thesis for FJ Labs. We did that at the big retreat, where that was my homework for the retreat, to think through, okay, what's happening in crypto, what should we do about it? And in fact, the next presentation, which will be about what are the trends of marketplaces, also came out of that, and that'll be probably early September. Actually, no, maybe the last week of August. Anyway, have a great week, and see you next time.